In business, the war on Iran has been sending shockwaves through global energy markets. With the ongoing fighting slowing tanker traffic through the Strait of Hormuz, oil prices have spiked to above $100 a barrel, leading to a global scramble to secure supplies. And countries are responding differently. Climate goals once dominated energy policy, but recent geopolitical and trade pressures are now prompting countries to turn to domestic sources of all kinds, from renewables to coal and gas. Those who have no access to fossil fuels have opted to accelerate wind and solar as well as battery projects. A Bloomberg analysis shows cheaper renewable energy could gain momentum as the energy crisis makes alternatives more attractive. And Europe's post-Ukraine gas crunch, for example, spurred a surge in solar deployment and battery growth. The Middle East conflict is also seen to boost interest in nuclear power, which is somewhat of a paradox, given the war began over Iran's nuclear program. Estimates from the International Atomic Energy Agency show the world's nuclear power capacity could more than double by 2050. Whatever the energy source, the Iran war has exposed the weakness of global energy systems and highlighted the urgent need for a new approach to fuel global economies. Now, let's bring in Sam Chua, principal with Rystad Energy. Well, Sam, good morning to you. So, your research suggests the crisis is now spreading well beyond oil into LNG power markets and even petrochemical supply chains. So with Asian gas prices already surging and electricity costs rising across major economies, are we looking at a broader regional energy shock rather than just an oil market disruption?
Yes, thank you for having me. So yes, we do see that the crisis has spread way beyond oil itself, primarily to gas, power, and downstream supply chains. So according to Rystad Energy for gas, we do see that the Strait of Hormuz carries roughly about 20% of global gas flows. And basically we do see that a closure of just 5 weeks do strip away 11 million tons of LNG from world markets. What we are seeing now is that Asian gas prices are up about 54% and around $20 per MMBTU today. For power, we do see that similarly in European markets where prices have already doubled to about from 58 euros to about $113 per megawatt hour. So likewise, for downstream supply chain, we do note that over 50% of clean products comprising of LPG and naphtha flows through from Hormuz to Asia. And we do note that already a lot of plants in Asia are already declaring force majeures and curtail production as well as in the Middle East. So we do see all these shocks hitting simultaneously across these three sectors with only months and weeks to cover.
And if the Strait disruption lasts several weeks, how quickly could those pressure feed into inflation and industrial production across Asia?
Well, that is also a little bit too early to tell. What we are seeing right now is that inflationary pressures are still cautionary. In a way, we do see a lot of governments have already announced that there would be rising onset prices coming along the way, given that a lot of these contracts, especially for gas, are on long-term contracts. We would see these costs creeping in a little bit later. As of now, what we are seeing is in the spot markets where we do note that prices of power, gas and oil are surging across the board, but I think we do expect to see the inflation point hit a little bit later part of this year.
And with LNG and oil prices now rising higher, like you've mentioned, we're already seeing oil and gas demand destruction in parts of Asia and coal-fired power stepping in to fill the gap. So do you expect this crisis to accelerate a broader shift back toward coal across the region, or is that only possible in certain markets?
Well, yeah, that is a short answer is as of now, we do see a bit of coal creeping back into the energy mix. But again, it is part of Asia that we see. So one thing to know is that for a start, I think coal has already dominated Asia's power mix about 40 to 50% across the region. As of now, given the current prices of gas, it may be unaffordable. And this is where we see coal really creeping in. And we do see that happening in Bangladesh, where it has already curtailed gas to power and switching to coal. We do expect to see a lot of this happening across in Asia, but and especially in countries with high gas dependencies. So, for example, we do note that in Japan and Korea, we do see that gas accounts for over 30% of the power generation mix, nearly half in Taiwan and 70% in Thailand. Coal cannot come close to really filling that void, given that there's such a huge gap over there. So we do see that Japan and South Korea really running coal harder, and they are doing what they can to drive coal utilization up. So is coal really the fallback fuel in this sense? In price-sensitive markets, yes, but it really depends, because for other countries, it really depends on the energy mix, and gas may be too central to displace entirely.
Well, coal prices have jumped sharply this year, but you argue that it's not simply a gas versus coal story. Tell us more about it.
Yes, I think just to put it into context, from Rystad Energy's analysis, we do note that coal prices, especially Newcastle coal, is up 13% year on year to about $116 per ton. We also do note that after the Qatar's LNG outage has surged up to $137 per ton. But basically, like what you say, it is true that it's not directly correlated, because we do see that there are other factors involved. In Asia, we understand that in Japan and Korea, there are nuclear maintenance underway right now, about 4 plants in Japan and 12 plants in Korea. So this may leave grids exposed, and we do know that coal will really fill the gap there. But in Europe, we do see that panning out a little bit differently, because of wind outputs have already surged nearly 40% this year. This has already displaced gas and coal. So it is an opposite outcome. So basically from these same price signals, but completely different results in all of these markets. And it's really dependent on the energy mix that we see. In Asia, it happens to be coal. In Europe, it happens to be renewables. So it will really depend, depending on the context, energy mix, and prices.
And right now, governments are clearly prioritizing energy security and keeping power supply stable, even if that means relying more on fossil fuels. But does this crisis risk slowing the global climate transition, or could it ultimately accelerate the push towards renewables once the immediate shock passes?
Yes, it is tempting to say really yes, but in reality, right now what we have seen is that climate goals have taken a backseat. All across the news, we do see a lot of countries and governments stepping up to keeping the lights on and managing inflation. But the backseat is very different from being trumped or being basically overtaken, because it's far too soon to call this a real retreat away from climate goals. Just to give things into context from our analysis, we do know that EU carbon prices have fell around 16% in 2026. But that weakness really predates this crisis and is driven by industry competitiveness, politics in Germany and Italy. China, South Korea, and Australia all have tightened carbon markets frameworks, especially during this same time period. I think just to take things a little bit into context as well, previous precedents from the Russia-Ukraine crisis, we have seen that Europe has put every single fossil fuel lever to fulfill its energy criteria. But then at the later part of the year, it has responded with the RE-Power EU, which is raising renewables targets. So one thing to really look out for is when this crisis settles, it will force a choice. Whether should we double down more on renewables as the energy security answer, or should we soften targets? So either way, you're going to have a very difficult conversation between affordability, security, and sustainability.
All right, Sam, thank you so much indeed for your comprehensive analysis there. Sam Chua, Principal with Rystad Energy.